Meta's share price is down 77% from the peak to its lowest level since 2015 for reasons that go beyond the general big tech sell-off. The stock has fallen so far because Zuckerberg is squandering tens of billions of the company's dollars on building his mysterious metaverse and appears determined to sink even more cash into the virtual reality black hole. Outside shareholders wish he'd stick to the safer game of flogging advertising space. Meta sells at a price-to-sales ratio of 2, and its price-to-earnings ratio of 9 is an all-time low. Investors should consider these factors important given Meta's dominance in the social media sphere. More than 3.7 billion people use a Meta-owned site every month, a level unmatched by any other social media peer. However, Meta faces a challenge with global saturation. Over 45% of the world's population is on at least one of its sites. To address growth concerns, Meta pivoted into the metaverse, going so far as to change the company's name to fit this strategy. Nonetheless, investors do not seem to share CEO Mark Zuckerberg's enthusiasm for the metaverse. In the third quarter, Meta reported revenue of $27.7 billion, a 4% decline from 12 months ago. Meta's $4.4 billion net income dropped 52% over the same period. A 45% increase in research and development spending, heavily related to the metaverse, seemed like a red flag for Meta Platform's future. Meta expects those losses to grow significantly in 2023 before slowing down. The stock fell more than 25% in the following session. There's no guarantee the metaverse will take off. According to the Wall Street Journal, Meta expected to have 500,000 users in its main Horizon Worlds app by the end of this year. It's since lowered expectations to just 280,000, since fewer than 200,000 people use the service. Additionally, the company revised fourth-quarter revenue guidance down to the $30 billion to $32.5 billion range. This leaves investors with little hope that its considerable metaverse investments will pay off quickly. Still, analysts forecast revenue growth will come in at 6% next year. That could make Meta's aforementioned price-to-earnings ratio of 9 seem inexpensive in time. While the company is clearly struggling, the underlying business is still growing, with the number of daily active users increasing and monetization of Reels making progress. When Facebook began in 2004, social media was still in its infancy. Facebook exploded in users, jumping from 305 million monthly users in September 2009 to 1 billion 3 years later. But the new guard of social media platforms, TikTok, Discord, Twitch, offers tailored social media experiences and a chance to join a service your grandma doesn't use. For an individual, it becomes how many platforms do I want to be on? And then also, what is the kind of information that I want to reveal about myself, or what are the kinds of posts I want to make? Social network trends resemble those in fashion. They take off, their popularity soars, and then a new generation of consumers decides those platforms aren't cool anymore. And that's exactly what's happening at Facebook and Meta's photo-sharing site Instagram. According to an August 2022 Pew survey, just 32% of teens say they use Meta's Facebook app, down from the 71% who said they used the app in a similar survey of teens conducted between 2014 and 2015. While 62% of teens say they use Meta's Instagram, 67% report using its arch nemesis, TikTok. TikTok has established itself as one of the top online platforms for U.S. teens, while the share of teens who use Facebook has fallen sharply. The pessimism surrounding Meta is astonishing but certainly not unprecedented. The performance of the stock is reminding of several technology companies during the dot-com crash, and recently several technology companies, including the Chinese counterpart Tencent, performed similar. So far, Meta has lost 76% of its value and turned from a company that was briefly worth above $1 trillion to a $250 billion company ranging only on the 33rd spot on the list of the most valuable companies in the world. When reading comments, I seldom see analysis and logic but just expressions of hate for Mark Zuckerberg, talking about karma. And while this is obviously no analysis, it is an expression for the sentiment surrounding Meta. In such a sentiment-driven environment, decisions are often lacking the necessary objectivity to make good investment, which might explain why the stock is trading below $100 and close to the point of maximum pessimism. Of course, fundamentals also justify the stock to go lower from its previous all-time highs of $380. And one fundamental problem is the declining profitability for Meta in the last few quarters. In Q3 of 2022, diluted earnings per share declined from $3.22 in the same quarter last year to $1.64 this quarter. And when looking at the results for the first 9 months, earnings per share declined from $10.11 in the same time frame last year to $6.82 this year. When looking for the reasons, we can mention several aspects. Cost of revenue declined about 1%, but the operating expenses increased dramatically. General and administrative expenses increased 15% year-over-year, and research and development expenses increased 45% year-over-year. And the result was operating income cut in half from $10 billion in Q3 2021 to $5.6 billion this quarter. But not only increased costs had a negative effect, revenue also declined 4.5%. Management was pointing out that on a constant currency basis revenue increased 2% year-over-year. We can also look at the different regions and different segments and see mixed trends.
The healthcare and travel verticals were the largest positive contributors to growth in Q3. However, this was offset by continued softness in other verticals, including online commerce, gaming, financial services, and CPG. On an advertiser-sized basis, revenue growth from large advertisers remains challenged, while we've seen more resilience among smaller advertisers. Foreign currency was a significant headwind to advertising revenue growth in all international regions. On a user geography basis, year-over-year ad revenue growth was strongest in Asia Pacific and rest of world at 6% and 3% respectively, with both regions continuing to benefit meaningfully from strong growth in click-to-messaging ads.
We should not ignore the problems Meta is clearly facing. Revenue growth is slowing down and, due to increasing costs, profitability is declining and earnings per share are crumbling. And the stock certainly deserved to decline in value, but a 75% decline was unjustified, especially as Meta was not so expensive to begin with, even more true when comparing to several hyped stocks. When looking at the results in more detail, there are signs to be optimistic. First, on a constant currency basis, revenue increased 2% year-over-year. This is still not great, but we should also not ignore the strong US dollar being a headwind. Daily active users for the family of apps increased by 4% from 2.88 billion last quarter to 2.93 billion this quarter. While revenue stagnated, the total number of ad impressions served across the different apps increased 17%, which is a good sign for underlying growth. Growth was especially driven by Asia Pacific and rest of world. On the other hand, the average price per ad decreased 18%, but the reasons might be temporary, like the shift to under-monetized Reels. Reels is growing quickly and at a high pace. According to Zuckerberg, there are more than 140 billion Reels plays across Facebook and Instagram each day, which is a 50% increase from 6 months ago. And although this is not backed up by numbers, Zuckerberg believes that Meta is gaining time spent share on competitors like TikTok. The path for Reels monetization seems similar than the path towards monetization of feeds or the switch to mobile. The company first had to focus on increasing engagement and growing demand for the products. Monetization efficiency followed in the next step. But Zuckerberg also admits it is hard to predict the monetization efficiency for Reels in advance. Aside from trying to monetize Reels more efficiently, Meta Platforms is also seeing another major monetization opportunity in messaging. In my opinion, investors are mostly scared by Mark Zuckerberg's plans for the metaverse and the huge expenses necessary. By focusing on the metaverse and seeing it as a huge cash-burning fantasy of a billionaire, they are overlooking that Meta is still a solid, highly profitable cash cow. And the vision of the metaverse is generating uncertainty, and investors don't like uncertainty. We can break this story down in two key messages: business cycle and investing in the future. Meta is a company undergoing a cyclical low, like several other technology companies, and is therefore reporting low growth rates and is struggling on several fronts. Considering the fact that we are on the eve of a major recession, it is not surprising for a business depending on advertisement revenue to report slowing revenue growth. And not only Meta Platforms is struggling, peers like Alphabet, Amazon, and Tencent are struggling as well. Besides that, Meta Platforms is investing in its huge vision of the metaverse, which is expensive and has a negative impact on the bottom line and the company's ability to generate free cash flow. These two aspects combined create a scenario that looks like Armageddon for Meta, but it is not. The first problem will pass, and revenue growth and profitability will increase again. The second problem could actually be a huge opportunity for billions and billions in profits in the years to come. And this is even if the scenario that Meta Platforms is failing with its vision of the metaverse and Facebook and Instagram just returning to normal ways of profitability after the recession is not priced in. The metaverse does not have to work out in any way for Meta to be a bargain. It is not like we are paying any form of premium for Meta Platforms on the hope of billions in profits from the metaverse. Just returning to previous profitability levels and generating about $40 billion in free cash flow would make the stock worth about $150 per share, without any growth assumptions. I don't like the term buying opportunity of a lifetime, especially as it was often used after small corrections, implying that a 10% or 20% correction is already generating a deeply undervalued stock. But Meta Platforms is a huge buying opportunity, in my opinion, and the stock could easily double or triple over the next few years as Meta Platforms is trading nowhere close to its intrinsic value. What do you think? Let me know in the comments.